So the upside story, chronic undersupply of housing, interest rates falling. Don't ever underestimate the sentiment power of interest rates falling to bring.
Because it's interesting with interest rates falling, is it, Ben? Because there's definitely a correlation with interest rates falling and property performance, but there's not the same correlation with interest rates rising and property performance. So on the downside, yes. On the upside, it's a mixed bag.
Yeah, 100%. And if you think also about, like, property is a great inflation hedge, right? Over the medium to longer term, it's a really nice inflation hedge when you own the property. If construction is getting more expensive to build and you own a home, you're getting that uplift in terms of that inflation streak. But guess what? That's going to come down lower. Technology, productivity, we're seeing all of over the next 5 to 10 years, how much AI will increase productivity. And that will also mean that there's going to be more challenges around inflation moving forward. But what we have got in this cycle is those real wages growing. So credit to the Labor government, the federal Labor government. They have been able to get a real wage increase on the back of this higher inflation story. Now, part of that had to do with inflation forcing the agenda on the story, but still, you've got to give credit where credit's due. So you start to sort of think about that story, in terms of those broader themes. And then we want to sort of start to think about that buyer demand. So what sort of data are we looking at from a buyer demand point of view? Well, our demand supply score is exactly where we want to be. And so when we think about demand and supply, what we're talking about here is where are those levels at? When we look at our 17 variables, we can see in terms of Hobart and Darwin are still quite challenged. There's just not a lot of appetite for buying in those particular centres. But then when we start to look at, centres like Perth, incredibly strong, Adelaide really strong, Brisbane strong, Melbourne, Sydney, Canberra and all of that, there's a heartbeat there, but it's not sort of at that sort of nosebleed, need to get in as much as possible. There's a little bit more patience in those particular markets. But let's talk about...
What we noticed too, Ben, was a lot of the demand comes through affordability, right? So when you say, Melbourne and Sydney and Canberra not at the nosebleed territory, it's because largely a lot of the demand was actually pigeonholed via people's borrowing capacity. So you can see that some of those towns that you pointed out, Brisbane, Adelaide, Perth, comparatively speaking to Melbourne and Sydney, they were a hell of a lot more affordable. Plus, people had borrowing capacities that were within the bandwidth that you could afford those states. So it was just a natural progression to see some of the activity pushing there. And just for those who are playing along at home, Ben, who haven't been exposed to DSR, you did quickly mention the 17 variables, but what you were quoting is our own algorithm that measures 17 variables that we then bring together with a weighting that allows us to go, where does the demand actually live at the coalface, and is the demand exceeding the supply? So just for those folks who haven't been exposed to that before.
Beautiful segue. I mean, we'll talk about auction clearance rates before we move on, but some of those examples of those variables that we're talking about is days on market. That's definitely, and it's also part of the location score product and our DSR data product that we also have available. And you can see here in terms of days on market, we are starting to see a shift in terms of median days on market, where we're now up nationally at 44 days before a property is sold in terms of combined regions. And in terms of combined capitals, we're at 29 days. So that's clearly showing us that, capital cities still have very much a heartbeat. And if we think about where they were in, 2019, 2020, they were up in the 40s, right? In terms of, 45 to 55 in January of 2019, now down at 29 in January of 2024. So make no mistake, there is a clear indication in terms of days on market says that's an underlying mood in terms of, where that days on market sort of story sits. And then if we look at the other one that's also worth noting outside of auction clearance rates, because really auction clearance rates are a good measure for Sydney and Melbourne, but they are a weak indicator for and a signal for other markets. But so let's look at vendor discounts. What we're also seeing here is pretty healthy, in terms of there's not a lot of vendor discounting going on. And in terms of a lot of cities and states across Australia, we're basically seeing that the vendor discounts are less than this time this year compared to this time last year. And if we're talking about a market that at the end of last year we were seeing potentially going into a flattening cycle, it's actually sparked up a little bit And I think that also speaks true to the auction clearance rates price.
Yeah, auction clearance rates have started remarkably resilient to begin this year, which, as you pointed out, is only a measure of Sydney and Melbourne. But what's interesting about that is the fact that they are very expensive markets relative to the rest of the country, and yet you are seeing that really strong resilience. So that is showing a fair bit of sign. It also reinforces the conversation we had earlier about where the finance commitments are. There is a bit of there's a bit of life definitely in those bigger markets, despite their relative unaffordability at a national level.
Beautiful. And one of our more sophisticated measures is a concept of market cycle timing. So we know that markets move in cycles, all right? And so what you're trying to also predict is when is an up cycle versus when is it at the peak of the cycle, and how long that up cycle is going to last versus how long it's going to be a short up cycle or whatever that looks like. And so we can see in terms of the data that we've got there that there's a really strong early stage cycle in markets like Perth. And so we think, as an example, Perth is going to have a sustained bit of growth because it did have for a long period of time there from 2013-14's peak to where it is today. It's basically just recovering some of that. So that would be an example of a market that's probably got a lot more to give. And then when you're looking at other markets where you're looking at, say, Sydney and Melbourne, they've had good runs, but they tend to go up and down in tighter cycles. And then when you're looking at Adelaide, it's had a really nice solid run. And then you look at Hobart, that had again another sort of breakout 20-year run that it normally does. Every 20 years it sort of has this run. And then you've got sluggish markets like Darwin, who's basically not showing any real indications of that that uptick just yet. But because it has been flat for about the last decade, it's logical that market is going to have some upcycle in the next sort of 2 to 3 years as part of that cycle. So that's
as a side note too, Ben, sorry just to jump in there, but I think it's important because as an investor, you've got to work out if you're chasing short-term gains versus long-term gains, and we're always chasing long-term because Hobart actually had its day in the sun. It had a nice little spike, particularly during COVID, which was benefiting from a bit of that move away. Darwin as well is off about 6% off its peak, which was a decade ago. Its peak was a decade ago.
Yeah.
Perth had a little. So the game that we're playing here, that we talk about on this podcast, is the long game, the decades game. So it's got to form part of the thinking, whether or not you want those short-term spikes that you can leverage to get into other markets, or whether you just want 2 or 3 properties that you hold for the longer term. So I think that's a reinforcing point based on the back of what you were just talking about.